Under the LIFO method, we're going to do the exact opposite, right? So if you noticed in the FIFO method, we started from the top down, right? We started from the oldest units to the newest units. What we're going to do in the LIFO method is the exact opposite. We're going to start from the bottom up, right? And we're going to sell the newest units up to the oldest units, okay? So what we're going to see is, we'll walk through it on the next page. We're going to sell 600 units from the October 19th purchase. That's going to be $6,600 total, okay? So we paid $11 per unit for those, okay? Okay, that's $6,600. That is a running total right now of 600 units. How many do we have left to sell? 200. So what are we going to do? We're going to sell 200 of the 300 units from the April 25th purchase, totaling $1,800, right? So that was at $9 per unit. Okay. Now we have a running total of 800 units total sold. Our remaining, our cost of goods sold is what? 8,400. It's just the sum of these two. Okay. So you can see that our cost of goods sold is higher than if we used FIFO, right? So we have a higher expense, right? What's that do? Well, it lowers our net income, and that's what we're looking at here, because that impacts your tax liabilities, right? So anyways, the remaining 200 units we split between the remaining units from the April 25th purchase, 100, so you're going to have $900 there, and the beginning inventory of 100 at $700, so your ending inventory is $1,600, right? And we'll notice that that is lower than FIFO, okay? So you're going to have a little less on your balance sheet, okay? So that's how we would calculate that on the LIFO method. Just remember, kind of just going from the bottom up with the LIFO method. And what it does is it ends up changing your cost of goods sold number and your ending inventory number. Why is that? Well, because you can see here that our costs are increasing here. So if we sell the ones that cost us the most up front, we're going to have a higher cost of goods sold. Whereas with FIFO, right, we've got the same increases, but we're selling the lower costs first. So you have a lower cost of goods sold. Okay, so that's kind of the tricky concept here, is realizing what happens when I use these valuation methods in times of rising or falling costs. How does that impact my balance sheet? How does it impact my income statement? Right? So next we're going to talk about a percentage of receivables method. So we do, nearly all companies that sell their actual inventory in a FIFO manner, right? We're going to sell the first ones we bought and keep the newest ones that we bought in stock. But we are allowed to report as if we've sold in the LIFO manner. And that's what most people will do. Why? Because the LIFO increases your expense, which reduces your net income, which in turn does reduce your tax liability for the year. So a lot of times what you see is, yes, we may have an actual flow of inventory in a FIFO manner, but we record in a LIFO manner, okay? Companies will decide which method of inventory valuation to use based on many different items, okay? Just really depends. There's going to be a lot of things that they use, a lot of information that they use to make that decision, okay? However, you do have to realize that there's a potential for significant differences in COGS, okay? As well as in ending inventory. So investors and creditors must be made aware of this methodology and the assumptions used when making those estimates, right? I'm just reading verbatim here. What this is saying is, because your COGS and your ending inventory, your income statement, your balance sheet can be affected so greatly, so significantly by the choice that you make in the method of evaluation, you have to make a note. This is where note disclosures come in, right? You have to tell them, oh, well, we use LIFO for this inventory, but we use FIFO for this inventory, and here is why. You can't just say, oh, we use it. You have to say, we use it, and this is why. There has to be an explanation for it, okay? So just a couple of quick facts about FIFO versus LIFO, and these will be important. These you will get tested on, I can almost guarantee you, okay? So the FIFO method, it really does match physical flow of inventory for most companies, okay? For most companies, this is just the way they sell. When you see people at Walmart or Target stocking the shelves, this is what they're doing, right? They're moving the old stuff forward and putting the new stuff in the back so that you were purchasing the older stuff first. When you use FIFO, your inventory, your ending inventory is going to reflect the current costs. Why is that? Because your older stuff, or the newer stuff, right? The stuff you paid for most recently ends up in your inventory, right? Most recent ends up in your ending inventory. Okay, we refer to this as the balance sheet approach. This is the balance sheet approach because of this ending inventory count, right? So here is the key. This is what you guys need to know. This is what they like. All accounting text, all accounting test banks, this is what they love to ask questions about right here, okay? So know this, write this down, it's very important. When purchasing inventory, when the cost of purchasing inventory is rising, a FIFO method will result in a higher ending inventory, a higher asset, and a lower expense, a lower cost of goods sold, right? It makes sense. Your older inventory that you paid less for is in your expense, and your new inventory that you paid more for is in your ending inventory, okay? This results in a higher gross profit, okay? So just know this little factoid about FIFO, okay? And then it's the exact opposite for LIFO, okay? Everything we just said about FIFO is the opposite for LIFO, okay? Again, they love to test on this kind of stuff. So your cost of goods sold is going to reflect your current costs, right? And your inventory, your ending inventory is not, okay? So this is the income statement approach because it's a reflection on our cost of goods sold. The focus is on our cost. The increase is in our cost, right, with LIFO. So when the cost of purchasing inventory is falling, right, then the LIFO method is going to give you a lower ending inventory and a higher cost of goods sold, okay? Because if your inventory costs, if your cost of purchasing inventory is decreasing and you're selling the older stuff that you paid more for, that's what ends up here in your expense, and the stuff you paid less for ends up in your inventory, okay? It results in a lower gross profit, which if you follow it all the way down to net income, results in a lower net income, meaning you have lower taxes, okay? And that's typically why people do this, is for tax purposes, okay? So let's take a real quick look at Mario's game shop example, and we will move on to the next video after this. So this is just a comparison of the two different methodologies, right? This is just a comparison. Same information, right? Same shop, but one of them uses in one instance we're going to look at FIFO, one instance we're going to look at LIFO. You can see our ending inventory is higher under FIFO and lower under LIFO. We said that would happen, right? Because our lower cost items are still in inventory here. Our higher cost items are in inventory here. Okay? Sales revenue is the same, but our cost of goods sold is different. Why? Well, because it's just the opposite of inventory, right? Our higher cost items are in our cost here, are in our expenses, and our lower cost items are in our expenses for FIFO. Here you can see it changes your gross profit. Okay. So if you have any questions about this, which I would imagine some of you will, and that's fine. This is what I said. This is the big example. This is, or not example, but this is the big deal from this chapter. This is the confusing ideal from this chapter. So if you do have questions about it, please don't hesitate to contact me. I am happy to answer those questions.